Coming off the heels of the June jobs report, just right. Not too hot, not too cold, just good enough to keep the Federal Reserve second-guessing their next move. The bond market, once again, flashing recession. The stock market, looks like once the second quarter and the first half of the year were over, everyone wants to start buying stocks again in the third quarter. Inflation, coming down, especially on commodities. And housing, my two new favorite terms, new price and newly priced, because they are certainly reflective of the reality of consumer affordability in this new interest rate environment. Welcome back to This Week in Mortgage, everybody. My name is Sam Battaglia, your mortgage broker here at Guaranteed Rate in Beverly Hills, right on Cannon. Hope you're having a great week. So we got the June jobs report today. A little bit higher, a little bit more jobs created than some economists had expected, but in my estimation, not too hot of a report, not too cold. Economy's not falling apart over this, and it's not overheating. This is just right. So where the Federal Reserve takes a look at this and says, what do we do next? So this is an interesting jobs report for them to get. Call it a Goldilocks report. Usually they know how to respond to Goldilocks, but not this time. Their response this month with the rate hikes is going to be very interesting. And the stock market, weird thing happened. Once the second quarter ended, headed back to last Friday, if you look back, looks like we found some footing and some stability in the markets. Now, my question is this. Is this just a mental thing that the end of the quarter in the second quarter was window dressing, and this might be some more window dressing to start the third quarter? So when financial advisors send out their reports, they did or didn't own something at the time they had to publish the report. But we do know from history, bear market rallies have been some of the largest ones in the history of the market. During a bear market, sometimes you get a bear market rally. You can also call that a dead cat bounce. Sometimes the cat just bounces higher than others. Or indeed, is this the bottom that everybody's hands are bloody from trying to catch that falling knife from? We will see. Only time will tell, but it certainly seems like since we turned the page on the first half of the year, people like stocks again. Moving on to the bond market, I'm getting a lot of questions about the significance of an inverted yield curve. The simplest way I can explain this is think about all the financial markets as a racetrack and think about the bond markets as a pit stop or a parking lot. So when people want to allocate their money and they don't feel like allocating it towards stocks or what could be called risk-on, riskier assets, they typically park their money in the bond market. And you can buy a number of different bonds from the U.S. government. The one I talk about is the 10-year Treasury, because that's about the closest one that mortgage-backed securities follow. But there are indeed 2, 5, 7, 3, 10, 30-year Treasury notes. But we'll just talk about the 2-year and the 5-year Treasuries being higher than the 10-year today. So basically, if you give the government your money for 2, 5, or 10 years in this example, they're going to give you a certain yield. Right now, the 2-year and the 5-year are giving you more of a return than the 10-year. What this is indeed inverted, meaning shorter maturities giving higher yields. And what this is a reflection of uncertainty because people who don't want to run in the race and buy stocks, for example, are very risk averse at this moment, and they actually don't know how long to be risk averse for, 2 years, 5 years, or 10 years. So this is the invert because nobody knows what's going to happen in the short term, the midterm, or the long term. So that is uncertainty. And as we know, uncertainty leads to instability. And that's why typically when there's an inverted yield curve on Wall Street, we end up in a recession. Any more questions about this, please send me a DM. Moving on to inflation. It is getting under control a little bit, surprisingly enough. Now I'm going to go through some commodities I usually don't talk about, maybe one or two of them, and I'll discuss them in barrels, bushels, stacks, however you'd like to measure these things, but these are their prices. Barrel of oil, down to about $104 a barrel. This actually did this week dip down to about $95, $96 a barrel, down from about $120. Here's a big one we're all interested in, lumber. Lumber's down about 55% from its recent high. It was trading at $14.40, and now it's trading at $650. That's down 55%. Copper, down about 30% from its recent high, from $4.93 to $3.52. Wheat is down from $12.77 to $8.93, again down 30%. Corn, this is the one you see at the grocery store most often along with wheat, down about 17% from its recent high. Gold, which this one's a bit surprising to me because it is the traditional flight to safety and quality. Gold is actually down 15% off its recent high and just slightly down on a year-to-date basis. Natural gas is actually down about 35% from 926 to 606. And steel is down about 57% from 1924 to 835. These are the numbers that the Federal Reserve is probably going to take a look at and say, hey, maybe we can chill out. This stuff has relaxed. Looks like the supply chains are getting a little better. Looks like the consumer's exhausted. And it looks like this is already being reflected in these commodity prices. So my advice to the Federal Reserve is you need to chill out. Moving on to housing. My favorite part about housing, as we know, is the mortgage market being liquid, and it is really liquid. We've actually had some interesting things happen in the mortgage world this week, and markets have indeed remained liquid, so the market is healthy. What happened in 2008 and 9 cannot happen again now just because of that. Back to my new price and newly priced. I love these terms. A lot of agents are very smart people, and they understand that half the battle is marketing and half the battle is being fresh on the market. So when you go new price or newly priced, this is a great way to say price reduction, along with my previous favorite term, price improvement. But I like that the listing agents are getting with it, understanding that the market has shifted because affordability is not what it was just about 6 months ago. As I mentioned last week, inventory should be getting a little better as we headed out of the 4th of July weekend. Indeed, a little bit more on the market this week, and I think some people are playing the game and waiting to come on till next week. We will see. And affordability has certainly come to an adjustment period where now this is the new era of home buying and mortgage lending. We've basically worked through the previous folks that expected to be tied to the previous era of mortgage rates onto the new folks that are fully expecting and fully comfortable with the new phases of affordability when it comes to housing. Okay, everybody, that is my show for this week. I hope you have a great weekend. As always, any questions about your mortgage, please don't hesitate to reach out to me. Thank you so much for watching. Have a great rest of the day.